All right, let's dive more into these bank earnings because, again, a mixed picture here from Wall Street. Bank of America actually beating expectations. Goldman Sachs, you can see that stock off just about 2% with less than an hour to go in the trading day. Joining us now, Zach Hill, Horizon Investments Head of Portfolio Strategy. Zach, it's good to see you here. So just first, I guess, your read on the bank earnings so far. Is it fair to say that the worst is behind us?
Yeah, so great to be with you here, Seana. So, high level, as we're looking at things, from a more macro perspective, as opposed to kind of in the weeds, the bank earnings we've seen so far have been better than feared, I think would be the way that I would categorize it. We're looking at guidance, how they're thinking about loan growth and deposits. And quite frankly, the biggest banks in the U.S. have benefited from the situation that's been happening for the last month. And so, we're seeing that reflected in a lot of their stock prices. Now, the real question for me is, does this continue to the small and mid-sized banks? And we're going to get some of those reports later this week and next week. And certainly I think that might be a little bit of a different story than what we're seeing in the large caps today and so far this earnings season.
I want to get to that in a sec. But speaking of what we're seeing in shares, Bank of America, pretty solid report all the way around, and yet shares basically around the flat line, up a 1/3% as we speak. Are you surprised at the investor reaction?
Well, the large cap financials have really been rallying, since the kind of the back half of March, as people realized this was not a 2008 style situation. And certainly last Friday, where we kicked off earnings season, was a good day, for the overall sector. And so I'm not surprised that we're not, propelling higher from here. Really, the kind of thing that's interesting to me is a divergence between a lot of the large cap banks and, the smaller cap banks, which are not faring very well today. And so that's something I think from a more macro perspective that we're keeping a big eye on.
But wouldn't you expect a better investor reaction to a pretty stellar report from Bank of America?
Yeah, I mean, I think in a market like this where there's just so many cross currents, a lot of things to think about, drilling in on a few hours worth of price action, especially when the narratives are changing as quickly as they are, is just a way to kind of get chopped up. And so we're at a high level, we're trying not to do that, as people that are actually, running money and live strategies, in this market environment. We're trying to pull ourselves away from that. And what we see, overall is, better than feared, at least from the large cap banks, in terms of what the economy is going to look like. And when you couple that with a lot of the momentum that we had going into this from the consumer side of things, this is a little more optimistic on growth in the U.S. this year.
Well, Zach, what do you think the economy is going to look like? Because there's a Bank of America fund manager survey that was out. 63% expect a weaker economy in the next 12 months. I don't think that number is particularly surprising. But when we talk about how weak, do you think a recession is in the cards and likely?
Yeah, I mean, that's not really a heroic call, right? I mean, we're running at really elevated levels of nominal GDP. And so, over these last 2 years, with inflation obviously much higher than what we've experienced in a long time, there's this kind of the dichotomy between nominal versus real growth. And I think that's kind of messed people up a little bit because we're not used to thinking that way. And so, at a high level, we do think things are slowing and they're going to continue to slow. I mean, that's exactly what the Fed is telling you they want to do. I think they're going to accomplish that, one way or the other. But then the question is, does that kind of spiral into some uncontrollable situation? And there, I think the starting place really matters. Really good debt service and leverage on both the corporate and the consumer side of things. There's some pockets of weakness. We may see some ups and downs. We're familiar with those. Over the last 3 years, if you were a goods producer in 2020 and 2021, you had boom times. And now if you're in the services, you travel, leisure, that type of thing, you're feeling boom times, whereas it was a complete recession for you 2 years ago. And so I think that kind of up and down stuff is going to continue for a while. But our broad read is that things are going to continue to kind of chug along here. I mean, we are late cycle. I think that's clear, but not the end of the world coming around the pike, at least as far as we see it.
You referenced the Fed moves. What do the better than expected bank results, how do they impact the future Fed moves?
Yeah, Dave, this is a really interesting question and one I think the market is grappling with. So, we saw a gigantic re-rating in Fed expectations post SVB, from 4 hikes to 4 cuts. I mean, that is really historic moves in the bond market. And the market clearly voted that this means the tightening cycle is over. And, this means that they're going to have to start cutting because they've broken something. And, we take the other side of that. There's some isolated cases within a few very poorly managed banks with, really quite incredible business models if you think about it, and it's not a systemic thing. And so, we've got a situation where you're substituting a little bit of credit overhang for additional rate hikes, and what exactly that's worth is something that the market is grappling with. And so we're not really surprised to see interest rates start to march higher. And furthermore, we're not really surprised to see stocks actually do okay in that environment because they're marching higher for the right reasons, right? They're marching higher because there's not a crisis in the banking system. And so we think that's good up until a point. And, where that point is exactly, I think it's a little bit higher than where we are today. But that's something that we're certainly keeping an eye out for.
What does this mean then for investors? Should they be still on the defensive side of it, or is it time to start maybe adding some risk given the fact that maybe we could see an upside here over the next several months?
Yeah, well, for long-term investors, I think the place to be is still the stock market. It's pretty clear that you need to be in that engine of growth. Rates are higher than they have been, but they're nowhere near where they were over a 30 or 40-year average type of period. And so that's kind of the high-level thing. And then where we think about positioning more tactically, and we are an active manager, we're thinking about the kind of the way things are going to unfold in terms of scenarios. And our kind of central scenario is a muddle-through situation. And so then where do we want to be positioned? Well, it's really kind of tilted towards quality. A lot of that is the kind of the tech and the larger cap trades, and looking for opportunities, where the markets get a little overextended, a little ahead of themselves. And certainly it looks like we may be doing that as we sit here today, to be a little bit more defensive, but not to do that full on recession trade type of positioning. And the areas that we're staying away from, the highly cyclical areas, things like small caps, energy. It's not 2022 anymore. We don't have this supply overhang situation, and so we're staying away from that cyclicality within the U.S. And looking instead for opportunities overseas, because we do see quite a lot of value in international stocks, and especially in Asia and with the China reopening this year.
All right, Horizon Investments, Zach Hill. Good to see you, sir. Thanks so much.